I remember the first time somebody told me what a 401k was. I didn't know if it was Roman numerals or an account or an investment option. I didn't know anything. Heck, I was so confused about retirement accounts, I just didn't want to contribute to them at all. Hey everyone, I'm Jacob Turner, former Major League Baseball player and current co-founder of Moment Private Wealth. I'm going to walk through a guide of the most common retirement accounts. I'm going to talk through the pros, the cons, the contribution limits, and make sure you stay till the end where I'll walk through exactly how I use my own retirement accounts. Let's start with the account that is the most common, and it was also the one that I was the most confused about, a 401k. So what is a 401k? A 401k is a type of retirement account that is often available to you through the employer that you work with. And the reason that a 401k is available is because the government wants to encourage people to contribute to their retirement. And what they do is they give you a tax benefit in the given year for a contribution that you make. So let's use an example. Let's say you're making $100,000 and you contribute $10,000 to your 401k. Well, that means on your tax return, instead of it saying that you made $100,000, it's going to say that you made $90,000 because you're getting a tax deduction for the $10,000 you contributed to that 401k. And when you contribute to that money then grows what's called tax deferred. So it's not growing tax free, but you're not paying any taxes along the way. And then what happens with it is when you go to take the money out in retirement after age 59 and a half, that money comes out and any gains you have. So let's say the $10,000 is now turned into $40,000. That $30,000 of gains is now taxed at ordinary income rates when you take the money out. The other big pro to a 401k is typically there's a company match. So what that means is maybe you put in a certain percentage of money and the company might match 3 or 5% of that money. I highly encourage people to really consider at least doing the company match. And the reason for that is the company match is free money. And if you don't take advantage of it, the company won't give you that company match. So those are the two biggest pros of a 401k. The tax deduction on the money that's going in, the tax deferred growth, and then you're getting the company match as well. The biggest cons of a 401k is, like we talked about, you're getting tax deferred growth, but you are going to pay ordinary income taxes in the future. That means that if you have significant assets outside of a 401k, you might be using those, still be in a somewhat high tax bracket, and then be forced to do what's called RMDs. RMDs are called required minimum distributions. And what that means is the government says, well, at a certain point, we gave you all this benefit of all this deferred growth. You're going to have to start taking money out of these retirement accounts. So what happens there is the money that you take out, any sort of growth that you've had above and beyond your contributions will be taxed at ordinary income. Now, this can be a little bit of a downside because it's not taxed at what's called capital gains rates, which would be a little bit lower. The other big con to a 401k is typically that money's going to be locked up in there, okay? So the money that you contribute, the earnings that you have, if you were to take it out before age 59 and a half, you're going to be paying roughly a 10% penalty on that money. That's a pretty big downside. So you always want to make sure when you're contributing to a 401k that you understand that this is really your long-term money. So what are the contribution limits to a 401k? For 2024, the contribution limits work like this. You can contribute up to $23,000 pre-tax or $69,000 with the post-tax amount. So the total contribution limit that you could contribute if you wanted to contribute every single dollar is $69,000. But typically what most people see is the $23,000 number. And the reason for that is this. When you contribute the $23,000 number, you're getting that tax deduction like we talked about. Any money that you contribute above and beyond the $23,000 in 2024, you're going to be already paying tax on it. So this is post-tax money. So let's use an example. Let's say we made $50,000, we paid all the taxes we owed on it, and we still wanted to contribute some more money to our 401k. We could contribute that, but we're getting an after-tax contribution then at that point. The other key contribution limit to understand is if you're age 50 and older, you can do what's called a catch-up contribution. So you can take that $23,000 number and you can actually bump it up by $7,500. So in 2024, your number is going to be $30,500. The key here is remembering and understanding that any money that we're contributing to a 401k really needs to be focused on the long term. In addition to that, we also need to understand that the money that's in there, as it grows, at some point we're going to be paying taxes on it. So I always want you to be thinking about what is my plan for today with my 401k money, but also what is my plan for the future with my 401k money. The next account that I want to talk about is the solo 401k. So as you guessed, it's much like the traditional 401k, but that little solo prefix at the front, what does that mean? Well, simply what it means is this. The people that are eligible to contribute to a solo 401k means that they're the sole employee of that business. The only other time somebody can contribute to a solo 401k is if their spouse is also included in that business. So potentially a husband and wife team or a spouse team owning a business can contribute to a solo 401k. Outside of that, you do not have the option to contribute to a solo 401k. The pros of a solo 401k are much the same. Traditional solo 401k, the money that you put in pre-tax is going to get you a tax deduction. It's going to grow tax deferred into the future. You're also going to have the option for the catch-up contribution like we talked about. The limits are going to be the same, $23,000 and $69,000. The catch-up contribution is going to be the same, $7,500 to bump you up to $30,500 pre-tax. The biggest thing to understand with a solo 401k is you have to understand if you are eligible to contribute to it. If you are not eligible to contribute to a solo 401k and you do it, which I've seen happen multiple times, you're going to run into huge consequences down the road. So my recommendation for you is if you're running a small business and maybe it's just you, if you're a solopreneur, if you're an athlete that's earning off the field income, you don't have an opportunity to contribute to a traditional 401k, make sure that you have a qualified team around you, understanding, am I actually eligible to contribute to this? And then secondarily, what are the best options for me in terms of the marketplace to make those contributions? One other pro tip. On 401ks, there could be an option for a Roth 401k or a Roth solo 401k. All that Roth prefix means is instead of the money going in and you getting a tax deduction in that given year, the money goes in, you get no tax deduction today, but that money grows tax-free and then comes out tax-free in retirement. So you want to make sure you understand what is your tax bracket today and what does your potential tax bracket look like in the future. The next account that I want to cover is the IRA. So IRA just stands for individual retirement account. And I want you to think about it like this. We just talked about 401ks and solo 401ks. An IRA is essentially the same thing. It's going to act in a very similar fashion. The biggest difference is you don't need to be tied to some sort of business to make that contribution. So it's an individual retirement account as opposed to essentially a group retirement account, which is what a 401k is. So the pros to an IRA are this. Depending on what your income level is, and depending on what your eligibility to contribute to a 401k is, there can be deductions for the contributions that you make, just like you can with a 401k. In addition, the money that's in a traditional IRA can grow tax deferred, and then you'll pay taxes at some point in the future. But along the way, any growth that happens, you're not going to be paying taxes along the way. Now, the biggest cons to an IRA are much like a 401k, because again, it acts very similarly. The money that you put in, if you were to take it out before age 59 and a half, you're going to pay a 10% penalty. In addition to that, it's very, very important. I stressed this earlier in this video, but I can't stress this enough. You need to understand that you are going to pay taxes on the money at some point. With some retirement accounts, it can be a ticking time bomb with those taxes. So you really need to understand what your tax bracket looks like today, what your tax bracket's going to look like potentially in retirement when you're taking this money out, because any money that you take out in IRA in retirement after age 59 and a half, any of that growth is going to come out and you're going to pay ordinary income taxes on it. So let's talk a little bit about the contribution limits for an IRA. The contribution limits in 2024. So if you're under age 50, the total amount is $7,000. If you're over age 50, the total amount is $8,000. Now, the really important thing to understand about contributions for IRAs is when are they deductible versus when are they not deductible. As you can see on this slide right here, a lot of it is going to depend on your income bracket. Okay, so how much money you're making in that given year, and then also your filing status. So you can see here that depending on what your income level is, you may or may not get either a full deduction for your IRA contribution, a partial deduction, or no deduction at all. Another important note to realize is what this chart is showing you guys is this is if you are covered by a 401k plan at work. If you are not eligible to contribute to a 401k plan at work, your contributions to an IRA are deductible. Okay, there's no income limit on that. This is for if you have a 401k plan or a solo 401k plan that you're contributing to, you need to understand that there's income limits to also getting a potential deduction on an IRA contribution. The next account that I want to talk about is one of my personal favorites. It's the Roth IRA. So what is a Roth IRA? Just like an IRA, it's an individual retirement account. Just like a 401k, there's money that goes in and there's potential tax benefits to that. But again, that Roth portion in front of it, that Roth prefix, just simply means that the money that you're putting into a Roth IRA goes in and you get no tax deduction in the given year. But the big benefit for you is that money then grows tax-free. It also comes out tax-free in retirement. And then one other caveat to this is really important for those that are high net worth or going to be ultra high net worth, is There's no RMDs in the future. Now, the reason why that matters so much is oftentimes what we see is when clients get close to retirement and they have a large nest egg saved outside of traditional retirement accounts, the only time that they're accessing this retirement money is when it comes time for RMDs. And essentially what's happening there is they're losing control of their tax bill. And that's why I love any sort of Roth retirement account. If we can get more money stashed away in there, we avoid taxes in the future, our growth is tax-free, and we avoid RMDs. So let's talk a little bit about the cons to Roth IRAs. To be honest, the cons to Roth IRAs aren't that great. There's really not that many cons. The biggest con is this. You really need to understand what is your tax bracket today versus what is your tax bracket in the future. I see some people that get so gung-ho about contributing to a Roth IRA and they forget that maybe they're in the highest federal tax bracket today, 37%. And if we looked out in the future and we did some planning and we estimated maybe they're going to be in the 22 or the 24% bracket in retirement, it would still make sense to potentially contribute to a more traditional retirement account as opposed to one with the Roth prefix. So the biggest con is you need to understand what your tax bracket is today and what your tax bracket is in the future. The other con comes with contribution limits. So let's talk a little bit about what the contribution limits look like. The contribution limits for a Roth IRA are very similar to an IRA. $7,000 in 2024, $8,000 over age 50 for that catch-up contribution. So the actual dollars you can contribute to it are the same. The really important thing to understand is you look at this chart, again, there's contribution limits or there's income limits to when you can contribute to a Roth IRA. So what I mean by that is if you make over a certain amount of money, you can't directly contribute to a Roth IRA. Now, I have good news for you. If you make over these limits, there is something that's called a backdoor Roth IRA. And here's essentially how it works. Step one is you need to make sure that you have no other money in any IRA accounts. Step two is to make sure that you do what's called a backdoor Roth IRA. So a backdoor Roth IRA looks like this. You contribute your $7,000 into an IRA account. You let it sit there for a couple of days, and then you convert it. Convert it just means you simply move it from your IRA account to your Roth IRA account. And at the end of the year, when it comes time for tax season, you file what's called a Form 8606, which helps the government track the fact that, hey, I made a non-deductible IRA contribution, and then I converted it to my Roth IRA immediately. And what that means is it allows you to get money into your Roth IRA even if you're over those income limits. The fifth account that I want to talk about is what's called a SEP IRA. So you probably guessed it, an IRA just stands for individual retirement account, just like a traditional one, just like a Roth one. But what does that SEP prefix mean? So what the SEP prefix means is it's for people that have self-employment income. Okay, so this is typically 1099 income. And the pros of a SEP IRA are this. Just like a traditional IRA, the money that you put in gets you a tax deduction when the money comes in. Then it grows tax deferred and you can take it out and you pay ordinary income when you take the money out. So it acts very similar to an IRA. Now, the downsides to a SEP IRA are this. Again, just like an IRA, at some point you're going to be paying ordinary income on it. So if you're not planning around when you're making the contribution versus when you're potentially taking out in the future and what that tax bill looks like, you could potentially be running into huge tax consequences down the road. The second big con to a SEP IRA is you have to have a specific type of income to make this contribution. Again, you have to have 1099 income. What that means is if you work for an employer, typically your income is going to be what's called W-2. If you have compensation outside of that, maybe you have, as an athlete, you have off the field income, maybe you're in a sales role and you're making commission on the side, that could be classified as 1099 income, which could allow you to make SEP IRA contributions. One thing I want to quickly note, if you have the option to make a SEP IRA contribution, you most likely also have the option to make a solo 401k contribution, because remember, in those solo 401k contributions, it's also 1099. I want to understand that there's potentially two options here if you have this 1099 income. Let's talk a little bit about what those contribution limits look like. So for 2024, the most you contribute to a SEP IRA is $69,000. But it's not quite as black and white as that. You can contribute up to 25% of your self-employment income. So let's do a quick example on this. Let's say you had $100,000 of self-employment income. That means the max amount you can contribute to your SEP IRA is $25,000. Now, remember how I said you could also potentially contribute to a solo 401k with this money. That same $100,000, you could look to put more money in a solo 401k. And that's why I always advise, not only do you need to understand what these retirement accounts look like, you need to understand how they apply to you in your specific situation. The sixth and final account that I want to talk about is what's called an HSA. So I know this video is about retirement accounts, and the HSA stands for a health savings account. So you might be thinking, is this really a retirement account? But what I'm going to tell you right now is this is one of my absolute favorite accounts. And the reason for it's pretty simple. Let's talk about the pros of this account. The biggest pro of this account is this is the one account that has what's called a triple tax benefit. So what that means is this: the money that you contribute, you get a tax deduction in that given year. In addition, as the money grows, it grows tax-free. And when the money comes out, it also comes out tax-free. Sounds too good to be true, right? So let's talk a little bit about the cons of this account. The cons of this account are pretty simple. The contribution limits, which we're going to talk about in a minute, aren't super high. And two, in order to actually maximize it and get that tax-free growth and that tax-free distribution, you need to make sure that it's coming out for qualified medical expenses. So then why am I bucketing this into a retirement account? Well, I'm going to tell you in a little bit about how I use all these different retirement accounts in my own personal life. But one thing that you can do with an HSA is it can essentially be this long-term health savings plan and healthcare plan for you. Think about how long we're living today. Chances are there's going to be medical expenses that come up in retirement that you're going to be able to use this money for. So let's talk a little bit about the contribution limits. In 2024, the contribution limits are $4,150 for a single individual and $8,300 for a family. Now, it's really important to understand that in order to make these contributions to a HSA plan, you have to be what's on a high deductible healthcare plan. So first and foremost, you need to make sure that you're on a high deductible plan to make sure you're eligible to make these contributions. But if you can, and you're on a family plan, you can contribute up to $8,300 in 2024. So again, just like I talked about in the pros, you're getting a tax benefit for the $8,300. You're able to invest that money. It's able to grow tax-free. And then when you use it for qualified medical expenses in the future, it can also come out tax-free. The other key note here is on contribution limits. If you're over the age 55, you can also do a catch-up contribution of another $1,000. All right, so I promised you at the end of this video, I would share how I use these retirement accounts in my own life. So to preface this, I want to say something that I said earlier in this video, but I think it's a really important point. Everybody's financial situation is different. And the goals that you're trying to accomplish are probably going to be a little bit different than my goals. The situation you're in is going to probably be a little bit different than what I'm in. So as I say this, just because I do it a certain way does not mean that you should, but it is going to give you some context on how I think about it, why I do things the way I do. So let me give you a little bit of background. My goal with my retirement accounts is simple. I want to try to lower my lifetime tax bill. So I'm not trying to lower my tax bill in one given year, but I'm trying to lower my tax bill over the course of my entire life. So for me, the first account that I make contributions to is a Roth 401k. So what that Roth 401k does is I'm getting no tax deduction in the given year, but I am going to get tax-free growth and tax-free distributions. And I'm also going to avoid RMDs in the future, which are really important to me. I want to make sure that I have full control over my tax bill in the future. Now, I only contribute up to our company match, okay? And the reason for that's simple. I want to have additional flexibility outside of this Roth 401k. So that's the first account that I contribute to. The second account that I contribute to is I do a backdoor Roth IRA contribution every single year. So I do $7,000 in 2024. I've been doing this for almost a decade. And really the goal here is I want to make sure that I have as much money as possible in my Roth bucket. The third account that I contribute to is my HSA. So the HSA is the health savings account. We are on a family high deductible healthcare plan. So we're able to contribute $8,300 in 2024 to that plan. Again, if you see a theme here, my goal is to make sure that I have the most control possible over my future tax bill. So all three of these accounts I mentioned, for me personally, are a really good fit for that because I'm not going to have to pay taxes in the future on the money. And I'm going to avoid any sort of RMDs where the government's making me take the money out and maybe I would potentially lose control of my tax bill. The other big thing that I've done, and this is somewhat of a nuanced thing, but I've done a lot of Roth conversions in the past couple of years. We didn't talk about what a Roth conversion is in this video, but in simple terms, what it is I took money that I had put in a traditional 401k when I was younger. I moved it to an IRA account, and then I converted it or I moved it to a Roth IRA. Essentially what that does is I have to pay taxes on every dollar that I make that conversion. So it was really expensive and tough to pay that tax bill, but it also gives me a ton of future control over my taxes. So again, what my goal is with my retirement accounts is simple. I want to make sure that I'm trying to lower my lifetime tax bill, but also a big focus for me is making sure that I have control over it in the future, which is why really a lot of my focus is on accounts with the Roth prefix or an HSA account where I'm getting that tax-free growth and I'm potentially avoiding RMDs in the future. If you enjoyed this video, make sure you like and subscribe. I'm putting out videos every single week on different personal finance concepts. And much like this, I always try to share exactly what I'm doing. It doesn't mean that that's what you should do, but I hope it gives you a better insight into how I actually use some of the tips, tactics, strategies that I talk about in these videos. Until next time, my friends.